Something nobody is watching right now is quietly pumping more money into the financial system than most people realize, and by the time they notice it, prices are already going to be higher. I'm not talking about the stock market headlines you catch on the evening news. I'm not talking about what gets said at a press conference every 6 weeks. I'm talking about the plumbing underneath all of it, the actual flow of cash moving through the banking system, the part nobody puts on a chyron because it doesn't fit in a sentence. Right now, that plumbing is loosening up in a way almost nobody outside of a trading desk is paying attention to. I've spent most of my adult life managing other people's money, and I've lost plenty of my own along the way, too. Enough of it to know that the thing that actually moves markets is almost never the thing everybody is staring at. It's always the quiet stuff, sitting underneath the noise, doing the real work while everyone argues about the wrong number on the screen. And there's a quiet shift happening right now with liquidity, the flow of cash through the system that I genuinely believe is going to make a certain kind of patient investor a lot of money over the next couple of years, while almost everyone else misses it completely because they're staring in the wrong direction. Before I go any further, I have to say this plainly because I mean it. What I'm about to walk you through took me the better part of 20 years and a few humiliating losses to actually understand well enough to use. I've sat across from people who charge real money, thousands of dollars, to explain a stripped down version of what I'm about to hand you for free in the next half hour. All I'm asking in return is that you hit subscribe before we go any. Not because I need the number to go up for my ego, because it tells me you actually want this kind of thing showing up in your feed instead of noise, and because it costs you nothing and takes you 2 seconds. If what I say over these next 30 minutes is worth anything to you at all, that's a fair trade. So go ahead, hit it now, and let's get into it. I want to start with how I actually learned to see this stuff, because it didn't come from a textbook and it didn't come easy. Early in my career, I was completely obsessed with earnings. I would read every report cover to cover, model every company down to the decimal point. And I still kept getting run over and over, by a market that seemed determined to do the exact opposite of what the fundamentals told me it should do. Stocks I was convinced were expensive kept climbing. Stocks that looked cheap on every metric kept getting cheaper. It took an older man I worked under early on, someone who had already made and lost a couple of fortunes by the time I met Kim, to finally sit me down and tell me, more or less, that I was staring at the wrong thing entirely. I'm paraphrasing him here because it's been decades and I don't remember his exact words, only the shape of the lesson, which is that earnings tell you about one company, but the flow of money tells you about the whole ocean. And it's a lot easier to look like a genius swimmer when the tide's coming in than when it's dragging everything out to sea. Once I started tracking the money instead of the earnings, my results changed almost overnight. Not because I suddenly got smarter, but because I finally started watching the right thing and stopped mistaking a good story for a good trade. So let's get concrete about what this liquidity actually is, because I don't want to leave it as some vague word that sounds smart and means nothing. Strip away all the jargon and it's simple. It's just how much cash is sloshing around the financial system looking for somewhere to go. When there's a lot of it floating around, banks lend more freely because they're not worried about running dry. Companies can borrow cheaply to expand, and investors start reaching for more risk because safe returns start to look boring. Prices across almost every asset you can name, stocks, real estate, commodities, even things like crypto, tend to drift higher during these stretches, sometimes for reasons that have very little to do with whether those assets actually deserve it on the merits. When liquidity dries up, you get the mirror image. Good, well-run companies get punished right alongside garbage ones simply because there's less money chasing everything at once, and it all gets more expensive to own. This is exactly why you'll live through years where the economy looks perfectly fine on paper and stocks still fall apart underneath you, and other years where the economic data looks genuinely shaky and stocks rip higher anyway, leaving half of Wall Street scratching their heads. People get tangled up by this because they're staring at GDP prints and jobs numbers. I've spent my career staring at the plumbing instead, and it's saved me more times than I can count. Now here's the part that almost nobody is talking about, and it's the whole reason I sat down to make this video. Most people believe the only lever that matters in all of this is the headline interest rate. Raise it, and things tighten up. Cut it, and things loosen. That's what gets printed in bold letters because it's simple. It fits in one sentence, and everybody can nod along without doing any homework. But underneath that headline rate, there is a second, much quieter system running the entire time. How the government finances its own spending, how much cash gets parked overnight in facilities most people have never heard of and never will, how much of a cushion banks are sitting on behind the scenes. I like to think of the whole financial system as a bathtub. The interest rate is the temperature dial that everyone stares at and argues about. But there's also a faucet, and there's a drain, and depending on how wide open each one happens to be at any given moment, the actual water level in that tub can be quietly rising even while the dial says the temperature ought to be falling. Right now, the faucet is open wider than most people realize, and the drain that had been pulling cash out of the system for the past couple of years is starting to run dry. That combination, faucet open, drain slowing, is the thing I'm telling you to watch. Here's why almost nobody sees this coming, and it's simpler than you'd think. It's boring. Genuinely, painfully boring. Nobody is going to build a viral video around government debt issuance schedules or the balance sitting in some overnight lending facility because it doesn't sound exciting and you can't explain it in 15 seconds flat. Financial media needs a story that fits neatly into a headline, so they cover the interest rate decision every single time because it's one number that goes up, down, or stays flat, and everyone in the audience can nod along together. Meanwhile, the actual mechanics of how money moves through the system, the stuff that ultimately decides whether that headline rate even matters at all, gets ignored almost entirely because it takes real time to explain and it doesn't photograph well for a thumbnail. I'll tell you something I've watched play out again and again over the decades. The people who've made the real money in this business are almost never the ones who reacted fastest to the headline. They're the ones who understood what was happening underneath it, usually months before it ever showed up as a headline at all, and who had already positioned themselves while everyone else was still arguing about the wrong thing. I've lived through this exact pattern more than once in my career, and it rhymes every single time, even though the excuse dressed up around it always changes. There was a stretch not that long ago where nearly everyone was convinced that central bank tightening automatically meant markets had to struggle. And on paper, sure, that made a certain kind of sense. But underneath the surface, the government was pumping enormous amounts of short-term cash into the system through an entirely different channel, and money that had been sitting parked and unproductive for years suddenly started draining back out into the real economy. The people watching only the headline interest rate got completely blindsided. The people watching the actual flow of cash saw stocks and other risk assets grind higher for months, almost against their own better judgment, because liquidity was quietly doing the heavy lifting the entire time, whether anyone wanted to admit it or not. I've watched some version of this going all the way back to the late 90s. I saw it again in the run-up to the financial crisis, when everyone thought they understood the risks and almost nobody was actually tracking where the money was really flowing. And I watched it play out once more coming out of the pandemic, when the whole world was staring at case counts and shutdowns while a completely different force was quietly reshaping every market on Earth. Different excuses dressed up in different clothes every time. Same underlying mechanism underneath. Cash sloshing back into the system lifts almost everything, and it does it quietly, well before anyone in the mainstream is willing to admit out loud that it's actually happening. So let's talk about exactly where we sit right now, because this is the part that matters most for your money, not the history lesson. Over the past couple of years, there was a genuinely enormous pool of cash sitting parked in one of these overnight facilities I mentioned, earning a safe, boring, government-guaranteed return and doing absolutely nothing productive for the broader economy while it sat there. That pool has been steadily draining down, which means all of that cash isn't just sitting idle anymore. It's flowing back out into banks, into money market funds, into exactly the kind of channels that eventually find their way. into stocks and every other asset you can think of. At the same time, the government keeps issuing staggering amounts of short-term debt just to keep the lights on and fund itself day to day. And every time that debt gets purchased, it briefly pulls cash out of one pocket before it recycles right back into the system, still looking for a return somewhere. Now layer all of that together, and what you get is a slow, steady, unglamorous increase in the total amount of money floating around looking for a home, happening at the exact moment when most people are completely distracted, arguing about whether the next rate move is a cut, a hold, or a hike. Frankly, that argument matters a whole lot less than the talking heads want you to believe it does. I want to be completely honest with you about what this does and doesn't mean, because I've personally made some expensive mistakes over the years, assuming a trend like this one was going to last. It doesn't mean every single asset goes straight up in a perfectly clean line. It doesn't mean risk vanishes or that you can stop thinking. What it does mean is that the overall environment is turning friendlier to risk-taking than the headlines would ever lead you to believe. And historically, that kind of environment tends to reward people who are willing to own real, productive assets rather than the ones sitting in cash, waiting for some perfect clarity that never actually arrives. Stocks tend to benefit from stretches like this. Real, tangible assets, things like commodities, infrastructure, property, tend to benefit as well. Hard assets that hold their value while a currency is being created in greater supply tend to benefit. Most of all, what gets quietly hurt is cash itself, sitting there feeling safe while it loses purchasing power in the background, while everyone holding it congratulates themselves for being so cautious and responsible. I've sat in cash during stretches exactly like this one before, feeling smart and disciplined the entire time, and then watched the market leave me standing at the station. It's an expensive lesson to learn. I'd much rather you learn it from me sitting here telling you about it than from your own brokerage statement 6 months from now. Let me tell you about the one time I got this almost exactly right, because it's the clearest way I know how to show you watching liquidity instead of headlines actually looks like in practice. There was a stretch where the consensus on every trading desk I knew was that the central bank raising rates meant risk assets were dead in the water. Full stop. No argument. Every strategist on television was saying the same thing, using the same charts, drawing the same conclusion. I remember sitting with my own team, looking at the same headline everyone else was looking at, and instead of asking what the rate itself meant, I asked a different question. I asked where the actual cash was sitting and where it was likely to move next. And what we found was that an enormous amount of money parked in short-term instruments was about to get redeployed back into the system, regardless of what the headline rate did. We leaned into that, not recklessly, but deliberately, sized appropriately, with a clear line in the sand for where we'd admit we were wrong. And it worked. Not because I was smarter than the room, but because I was asking a completely different question than the room was asking. I bring this up not to pat myself on the back. Believe me, I've had plenty of humiliating losses to balance the ledger, but because it's the cleanest example I have of what this actually looks like when you apply it, instead of just nodding along to a video about it. I also want to walk you through what tends to happen to different kinds of assets, specifically when this liquidity backdrop turns favorable. Because I don't want to leave you with a vague feeling and nothing concrete to actually think about. Broad equity indexes tend to grind higher, often led by the more speculative, higher growth names. First, because that's where extra cash tends to go, looking for the biggest possible return. Real assets, things you can actually touch, tend to do well too, because when the supply of money is expanding, the price of scarce, tangible things tends to rise right alongside it. Smaller, more cyclical companies, the kind tied to actual physical activity in the economy, factories, materials, construction, tend to benefit disproportionately in these stretches compared to giant, already massive companies that everyone already owns. And credit markets, the world of corporate borrowing, tend to loosen up too, with companies finding it easier and cheaper to raise money, which in turn fuels more expansion, more hiring, more of exactly the activity that keeps this whole cycle turning over. None of this is a guarantee for any single stock you pick. It's a description of a tide, and I'd rather you understand the tide than obsess over one particular wave. There's also something I've learned the hard way about not getting greedy the moment you spot something like this, because this is exactly where people end up blowing themselves up financially. Understanding that liquidity is quietly turning in your favor does not mean you march out and take some reckless, oversized bet on the riskiest, most exciting thing you can find. Every single time in my career that I've actually made real money off a shift like this one, it's because I sized the position like a responsible adult. I had a crystal clear idea in my head of exactly what would prove me wrong, and I got out fast the moment the evidence changed, instead of falling in love with my own thesis and defending it like it was my child. The biggest, most painful mistakes I've made across my entire career weren't from being wrong about the direction of a trade. They were from being right about the direction and then getting so drunk on my own confidence that I stopped respecting the risk sitting right in front of me. Liquidity can turn against you just as fast as it turns in your favor. And the exact same plumbing that's quietly filling up the tub right now can just as easily start draining again the moment the government changes how it finances itself, or the moment the central bank decides it needs to step back in and intervene. Respect that possibility. Don't treat any of this as some kind of guarantee. Treat it as a probability that's currently tilted in your favor, and manage your risk like someone who's already been burned before. Because sooner or later, in this business, you will be again. So here's what I actually want you to do with all of this. Because listening and nodding along does nothing for your bank account. Stop getting your entire read on the market from whether some interest rate moved a quarter point up or down, or stayed flat for another 6 weeks. That's the temperature dial. It is not the water level, and it never has been. Start paying attention instead to the broader flow of cash moving through the system underneath it, whether that overnight cash pile I mentioned is still draining or starting to refill, whether short-term borrowing by the government is picking up speed or slowing down, whether banks generally seem flush with cash or squeezed for it. You do not need a finance degree to track the general direction of any of this. You just need to know that it's the thing that actually moves markets instead of the thing that happens to get the headline every single time. Most people are going to spend the next year genuinely confused about why markets keep grinding higher, even when the news sounds uncertain, or even outright bad. You do not have to be one of those confused people anymore. You now know what's actually happening underneath the surface. And knowing that puts you meaningfully ahead of almost everyone else watching the exact same news that you are. I'll leave you with something to actually do, because I think watching a video like this one and nodding along by yourself does absolutely nothing for you if it stops there for the next month. Every single time you come across a headline about the central bank or interest rates or the economy in general, I want you to pause and ask yourself one simple question. What is actually happening to the amount of cash in the system right now? Underneath this headline everyone's talking about, don't just passively accept the story you're being handed by whoever's on your screen that day. Go find out for yourself, even if it's just glancing at whether that overnight facility I mentioned is still shrinking or starting to grow again. That one habit alone, practiced consistently, will put you ahead of the vast majority of people who call themselves investors, because most of them have genuinely never once looked past the headline in their entire lives. I've made a good deal of money in this business over the years, and I've lost plenty of it too. And if there's one thing that separated the good years from the bad ones for me, it's whether I was watching the real thing happening underneath the surface or the thing everyone else on television happened to be talking about that week. Subscribe if any of this was worth your time today, because I intend to keep pulling back the curtain on the parts of this game that nobody bothers to explain to regular, hardworking people. I'd rather you hear it from someone who has actually lived through every one of these cycles with real money on the line, scars and all, than from a headline that's simply trying to get you to click. Take care of your own money. In the end, nobody else is ever going to do it for you. I've sat through enough market cycles now to know that the people who did well weren't necessarily the smartest people in the room. They were the ones who stayed curious long after everyone else got comfortable with a simple story. Curiosity is a strange thing to bring up at the end of a video about markets, But it's the honest truth of what separated the investors I respect most from everybody else. They kept asking one more question when the room was ready to move on. So ask one more question. Look underneath the number everyone's arguing about. That's really all I've got for you today. And it's more valuable than most of what you'll find dressed up in a much fancier package elsewhere. I'll see you in the next one.